So thanks again for tuning in. I know there is a lot of concern out there about the direction of the economy at the moment. When it comes down to it, staying invested is the most important thing to do when it's also the most difficult thing to do. That's especially true and hard in periods like 2022, where we've had a sideways to down market drag along for over 9 months now. Even when you understand the academic and the math reasons behind the logic of staying invested, it can get discouraging for sure the longer this sort of market drags on. The objective in this slideshow is not to make a whole bunch of specific predictions. It's more to talk through the stories and the narratives that you're hearing and reading a lot of headlines about lately. So I'm not trying to push any specific narratives one way or the other. I will offer you some narratives, though, that I think are objectively justified, just based on the data, and I'll show you those in a bunch of charts. So more trying to arm you with some facts and insights to help you understand what we're doing here or what we may not be doing here with your money that you've invested at IIM, and then maybe also arm you with some ideas that can help you think about your own personal finances outside of IIM. And for instance, we'll talk more about housing and inflation. So my hope is all this helps alleviate any stress you may be feeling from those external factors and not adding to it. So here's the agenda. Here are some literal and some paraphrased versions of what I'd say are the top half dozen questions we've gotten this year. First question: why have markets pulled back again? Second, is inflation getting worse? That's one of the main drivers of the market all year. We'll spend a little time on that. Number 3, will the Fed cause a recession? It's a key source of worry right there for a lot of folks. Number 4, how will the midterm elections impact the markets? Midterms have been kind of pushed to the background given all the other headlines of late, but that question still does come up every once in a while for sure. Number 5, what's slowing down the housing market? That's a big one for some folks as well. And number 6, should I hide in cash? I put that in there a little tongue-in-cheek. I think everyone here clearly knows what that answer should be, at least what I think it should be. But it's important to talk about nonetheless. So let's do it. Let's start big picture. A lot of what we've seen so far this year is historical, and I say historical with a capital H, historical volatility. A lot of wild swings, a lot of different days. And while it's usually that 20% plus decline in the U.S. stock market this year so far that attracts most of the headlines, the global bond market has also undergone a pretty brutal repricing this year. Global fixed income markets have had to really totally reprice the outlook for central bank policy rates in 2022. That has not at all been a smooth process either. A month ago, bond market volatility was at levels not seen since back at the peak of the COVID-induced market crisis of March 2020. So here in 2022, if you're talking volatility, you're really talking about inflation. That's a key driver in both stock and bond markets. And if you go up to the 30,000 foot view, you can kind of see that this multi-decade trend in interest rates and policy is now over in the right-hand side there. Really, it's now kind of shifting as we speak. So after that long inflationary period in the 70s and early 80s, we had what some folks call the Great Moderation, which in a nutshell was essentially 40 years of falling interest rates and pretty low inflation here in the U.S. It's relevant because the playbook that the Fed developed back then, and that was eventually copied by other central banks around the world. The playbook of the Fed was to use monetary stimulus to counteract those cyclical forces, or in other words, economic slowdowns. So more recently, like it did in 2008, that playbook meant the Fed would need to stimulate the economy a ton, which it did, lowering rates, increasing the balance sheet. It also led to fiscal stimulus from the politicos in charge, all of which is still in the playbook, and frankly, which came in handy when COVID hit in 2020. So those tools are in the playbook. They were reliable, dependable, and so the Fed, when COVID first broke out, took them out again. The big difference now, though, or the curveball in the playbook, is that inflation was low prior. That whole great moderation stretch of time was a different sort of inflation outlook. So while the playbook worked well then, now, though, inflation is here. So it just, in the slide, I like it, in that sense, it's easier to understand why these big shifts in the market have been happening, I think. It's really the cumulative effect of the whole system trying to readjust for this inflation and a lot of the secondary factors that drives. Again, for 40 years, we had a pretty easy lever to pull when it came to stimulus. There was a ton of liquidity out there. And yet, when inflation showed up as strong as it had a bit earlier this year, it was kind of like trying to quit drinking coffee cold turkey. It's going to give you a pretty noticeable, pretty persistent headache, at least until things stabilize. So, I felt like this is a great chart to show you, just that this historical trend that's now reversing on the right-hand side. And, there's no denying those interest rates have risen this year in a way that breaks the historical pattern. So what does this mean for stock and bond markets? Short version is both are down, which is in and of itself a rather unique time. You can see that on the right-hand side there. Usually, the performance of stocks and bonds balance out to an extent, at least, right? I mean, that's the whole point of diversification across those asset classes, really. I've highlighted some periods in here where bonds or fixed income, if you like, had some tough years starting over there in 1994, or when stocks had some tough years, like in 2008. And you can see how stocks and bonds in general counterbalance each other. Again, though, all while interest rates were low during that stretch. Another way to see how challenging this year has been for a lot of folks in the market is on a chart like this. Here we've got ranked quarterly return periods for the S&P 500, total returns, that is, so including dividends. Quarterly return periods for every quarter since back in 1988. So as per those two gold bars on the left part of this chart, right now we've just seen some of the worst quarters in that whole stretch. The worst quarters we have seen since 1988 here in 2022. To be clear, the timing matters in those gold bars for this year. The fact that the market peaked right on January 2nd does make this a little bit anomalous. In other words, it's a bit more dramatic than it might otherwise be to see those 2022 quarters stacked where they are. That's to some degree subject to just how these things get measured. Still, though, I think the point I'm trying to make here is that, the market has clearly struggled this year, and in some ways to a historical degree. That said, I do think it's important to keep that in perspective, and I think you can see that here, or at least that's what I was trying to go for here. Excuse me. This chart shows the total returns of the stock market in the blue bars there, and the largest intra-year decline in those reddish dots for each year. So yeah, S&P 500 was down big this year, but some perspective is important. Look at last year; it was up 29%. It was up 18% in 2020. In the year the global pandemic known as coronavirus hit, the market was up pretty big. It was up 31% the year before. The average year still sees a significant intra-year drop, but most years, in spite of that, still end in positive territory, especially if you include dividends. So the point is really that, all right, volatility and prices, it is a normal part of investing. And every one of these years, there were always reasons not to invest. There were always what seemed to be good arguments for selling out of the market or going to cash. In 18 and 19, recession seemed very likely. We had an inverted yield curve, trade wars. In 2020, the pandemic seemed like it should be a good reason to just avoid the whole mess. However, patience is a competitive advantage as an investor. As bad as things may feel out there today, in red, in the lower rate there, the market is down since the January peak about 22% through yesterday's close. But if you even just go back to the pre-pandemic market high, the high, again, not the low, the market is still up about 11% since early 2020, right before that Joker ate that bat or whatever. And then in 2019, as measured since then, the market's up 50% over the last 3 3/4 years. So just another way to kind of underscore that one of the key principles of long-term investing, right, is keeping that market volatility in perspective. And that means not just focusing on recent performance, but on the broader context and different time frames too, for sure. Back to the sort of more behavioral aspect of things as an investor, I just want to emphasize or maybe commiserate that it can be extremely uncomfortable to invest at times. The irony is, however, that is also usually the exact time you should be investing. Tried to capture that here. This is the AII Investor Sentiment Survey. It's a pretty simple survey. Comes out every week. And as you can kind of tell in here, investor sentiment has swung wildly on a weekly basis throughout this whole cycle, really. Excuse me, get a little drink of water here. Of note, kind of on the right-hand side of this, investors in this survey, have never been more bearish than over the last month. That bull-bear spread bottom was at looks like 43% just a few weeks ago. It's up a little since, but the percentage of investors that are also neutral is way down as well because they are more bearish. The point is, when the market is doing the worst, people feel the worst, but that's also when all the opportunities arise because valuations are typically at the lowest. That may not necessarily be the case right now in certain sectors, but in general, more a comment about investor sentiment than market timing for sure. Sentiment is often a contrarian indicator, and I say that both ways, right? Like when people are making hundreds of thousands of dollars selling images of cartoon monkeys as something called NFTs, okay, well, that's a sign that perhaps maybe there's a little too much irrational exuberance, a sign the other way. When people get too bearish, though, and just sell out of fear or emotion, okay, well, that's a sign that I feel like we as long-term investors want to key in on. And even though, it feels like, man, these headlines do not sound good, I really should do something. Because it's so hard to predict the future, it's even more important to stay disciplined. And staying disciplined almost always means not overreacting to short-term moves in the market. So a handful of slides there that just kind of explain what you've already seen or sensed or known, which is that inflation and the secondary consequences of that are really making 2022 very volatile in both stock and bond markets. Let's switch it up a bit and talk about why, in spite of all that, sitting still is the optimal strategy. And that really comes down to valuations. When you talk valuations, you're usually talking earnings. This chart shows the S&P 500 index alongside its trailing 12-month earning per share. We've got the market in the dark blue line there. It's almost black, I guess I should say. And then the light blue shading behind it is corporate earnings. Those two don't always or don't necessarily track identically in the short run anyways, but over the long run, the stock market tends to follow earnings. When the economy is doing well, you kind of get a twofer as an investor who owns stocks, because as the economy grows, so should the overall earnings of the companies operating in it. And then if company earnings or profits are rising, investors are also willing to pay more per share for that company. So company valuations increase because first, that company is making more profit. And then second, because investors are willing to pay more for every dollar of that profit. All right, stepping back a little bit here. The challenges we're talking about in the economy are targeted in very specific parts of the economy these days, and in very specific parts of consumer spending. The overall economy still has some pretty specific, pretty bright spots too. And to date, one of those bright spots has been corporate earnings. So far this year, corporate earnings have hung in there. In the upper right, you can see that while the market is down, earnings are higher. But remember, there's also a lag to those figures, and we're just now getting into Q3 reporting season. That said, there appears to be good reason to believe that the earnings growth is going to start to slow down here before too long. And that's in an indirect way. That's kind of the Fed's whole point, right? To cool off the too hot demand and that inflation in the economy that came roaring back after reopening from COVID. But it's also important to understand we're talking about a deceleration in earnings growth, not negative earnings. So a slowdown in the positive earnings growth that we have been seeing. So to put some numbers and valuation context around this, on a trailing basis, the market expects the S&P 500 to do about $220 in corporate earnings by the end of this year. Excuse me. Look on the right-hand side for a sec while I take a swig of water. So 220 in corporate earnings by the end of 2022. That is actually a 10% earnings growth rate over 2021. And 10% is in fact far above average. If you look at Wall Street average earning estimates for 2023 and 24, what they call consensus estimates, the street is still expecting earnings growth to expand in each of the next 2 years by 7 to 8%. 7% per year, I should say. Now, again, it seems rational to presume those numbers may come down due to the slowing economy. This is a Fed-engineered, COVID-triggered slowing of the economy. But the point is we're still talking about trimming estimates from a very strong level of earnings growth. So to summarize, though earnings are likely to slow down as the Fed tries to cool off demand out there, the context, which I feel like is important, is that they are still quite strong, and it looks like they should stay reasonably strong. And that should help support valuations out there to some degree, though you couldn't necessarily tell from sentiment in the market. To try and tie this into valuations a little bit more, just looking at the PE ratio of the market. This is the next 12-month earning estimates, so it's forward rather than backward looking. We can see different peaks and valleys in the past. Tech bubble saw that PE and forward earnings approaching 25x. We hit sub 10 times in 2009 there. Today we can see that valuations are still above average, but are really way more attractive than any other time in the last few years due to this recent market pullback. One thing that this slide could be telling us, it's not quite clear yet, but it could be telling us that the market doesn't think an economic slowdown is going to be that serious. For sure, this is not a short-term predictive tool. There are a number of ways other than forward PE to try to get a good gauge on market valuations. This one is just easy to illustrate. But this is still, in my mind, a good data point to note that, okay, well, right now, the market is actually just below its long-term historical average PE ratio on a forward basis. It doesn't mean it'll stay there. You can see it rarely hovers in one spot for long. But as a snapshot of where we are right now, because the prices of those stocks have gone down faster than the estimates of their future earnings, even if earnings estimates do start to get walked down from very strong levels to okay levels, then again, there should still be some valuation support for where the market is right now. Excuse me. Here's another quick snap. Kind of a wonky chart with some big ramifications, so I think this will be worth it. Just stick with me for a second. This is the relationship between valuations and earnings. So x-axis is that same forward PE ratio as the last slide. Y-axis is forward annualized returns. Gold dots over the 1-year periods, blue dots over the 10-year periods. Over the 1-year periods, in general, PE ratios don't tell you much about what will happen. But, and this is kind of the key part, for any particular PE ratio, over 10-year periods, there is no better indicator of forward returns than those valuations. So, no guarantees. It's the market after all. But if you are going to rely on anything, it should absolutely be valuations in terms of what your forward returns will probably look like. And so that context, valuations aren't nearly as low as in years, say, on the left half of that quadrant. But being there in the middle of that axis like we are, historically, that has meant right around 8.5% annualized return range going forward. And that is an attractive level. It's not a guarantee, but if the question is, are valuations attractive here in the broader market? The answer at the moment, in my mind, is yes. There are certainly specific sectors inside that broader market that are even more attractive, and there are certainly some that are less attractive, just again based on valuations. There is a case to be made here. I'm biased, but I think there is, all this kind of points to the case to be made for stock picking as opposed to just buying index funds in there as well. And yeah, look, I mean, that S&P 500 valuation today is still much better than where it was a year ago, excuse me. And I feel like that's arguably a silver lining at this point in this year for sure. Inflation, I said before, it's the big story this year. I'll have a little bit more on that in a minute. But one other thing I wanted to be sure to address is the U.S. dollar. Dollar's also been a big factor this year in the U.S. market even. You can kind of tell just looking at this slide. Major global currencies, including the dollar, have also been extremely volatile, really for the past few years, not just 2022. This year, though, we've seen the dollar strengthen in value, in particular, really the last few months and really the last few weeks even, as the UK tries to get it together over there. And as the U.S. economy recovered over the past 2 years from COVID and with the Fed now raising rates, there's a handful of factors that explain that dollar strength for sure. The point I want to make here, though, is that there can be a conflict between what you might want in the dollar as American citizens and taxpayers. Strong dollar means we're in good standing, among other things. There can be a conflict there between that and what the market might want, which is really for the dollar to be at the right level, at the appropriate level, as opposed to having the dollar be too strong. A strong dollar can ding economic growth in the U.S. Our goods become more expensive for foreign buyers is the short version, and when that happens, that slows down the earnings growth of the U.S. companies that sell overseas. At the moment, I would say that's probably a good thing, to help get inflation under control. A strong dollar that slows down that wedge of U.S. growth that comes from selling things overseas is helpful. Again, it's kind of what the Fed wants to do, so there's sort of a natural check and a natural balance in the system. History also shows, though, that this sort of recent strength will eventually fall off, which, again, is arguably a good thing for us because it'll help boost those corporate earnings again. So that's also been a factor, a little less obvious, or fewer headlines than rates and inflation, but has been a behind-the-scenes driver for sure.